Good morning, it's Jeffrey Christian from CPM Group. It's a little bit after 11 o'clock in New York. Gold and silver prices were off a little bit this morning, the way it is. I wanted to talk today about sort of the economic and financial environment that is in which gold and silver are behaving. In the 1980s, would-be competitor of ours was asked about the fact that we had been right on calling the peak in gold prices in 1988 and wrong. And he said CPM Group and Jeff Christian don't accurately call the gold price. They call the overall global economic outlook and equity markets well. And I thought, well, I'll take that. You know, the reality is our gold projections then and now have been pretty good. But they are, in fact, predicated on our view of the economic environment and the political environment and the financial markets that compete with gold and silver for investors' attentions. And back then, you saw a lot of, well, there were only a handful of gold and silver analysts out there at the time, but they tended to focus on supply and fabrication demand as opposed to investment demand, because investment demand was so hard to understand and quantify. Estimates of. And we focused on all of it, and we said, look, investment demand really drives the price, and you have to understand investors and why they're doing this. And some investors invest in gold based on the fundamentals of gold, but most investors invest in gold predicated on the financial and economic and political environment. So you really have to study those things. And being on Wall Street as opposed to coming out of a university somewhere, we were kind of keyed into the financial environment. So we did a pretty good job. It's the way it is. So I wanted to focus a little bit on that. Now, obviously, gold and silver prices came down. They bounced back over the last couple of weeks, sort of has stalled out, and they're showing some signs of renewed weakness. We still think that you will probably see relatively flat to lower gold and silver prices over the remaining half of August. But we're getting toward the period of time, September, October, when investors and industrial users of these metals start picking up their interest and refocusing on what they want or need in terms of precious metals. In addition to that, you have the US election coming up. You have issues with China and Taiwan and the United States. You have other factors that are ongoing that may well become more important and prominent going forward. So our expectation is that the prices are vulnerable to the downside right now in terms of our short-term trade recommendations for gold and silver. They are sell right now with a view for the next week or two. But beyond the end of August, we think that prices may start looking a little bit stronger and start moving modestly higher. And that's sort of where we are with the gold and silver prices right now. This is our economic outlook, and I've used this chart from time to time. This is 10 years of projections. The orange line are the advanced economies, as the IMF and World Bank use the term. The blue line is the world, real gross domestic product, and the gray line are emerging and developing economies, as the IMF and World Bank use that term to refer to them. And you can see, you know, we saw a very deep recession. You can see the 2007-2009 recession, then you can see the 2020 recession, which was very deep and steep and shallow and short. Deep and short. We had a very strong 2021 recovery. We're seeing weaker economic activity around the world in 2022. CPM Group's view is that things remain weak in 2023. We have industrialized world GDP just above zero next year, so pretty flat. We have the emerging economies kind of moving sideways, slightly higher perhaps, and the world starting to slide further. And then, again, we're looking for a recession in the industrialized world sometime maybe 2024, 2025. And that will obviously hit the world heavily. So that's our economic outlook. In the next 18 months, kind of blah economic outlook, but recession probably holding off. Now, this is US quarterly GDP. You can see 2 quarters below zero, the first quarter and the second quarter. The second quarter is just the first estimate, or the flash estimate, which was released on July 28th. It showed negative 9% contraction in the US economy, which ostensibly says this is a recession, 2 quarters of negative growth. Most of the weakness that we saw in the first and second quarter had to do with reductions in business inventories. Part of it was supply chain problems restricting the delivery of materials into inventories. And part of it was businesses saying, hey, we think that we're headed toward much lower growth in consumer demand and for our products, so we're going to lighten up our inventories. Consumer demand has actually held up very well. So there are any number of economists who are saying that, if this is a recession, it's probably short and shallow, because it really looks like it's more a inventory management issue that's causing the negative figures. We're not convinced. The second estimate for second quarter GDP will come out on the 25th of August, and the final revision will be released on the 29th of September. And those, you sometimes see very large revisions from the first estimate to the second to the final third revision. So we're waiting to see how those numbers come. But as I said a few weeks ago, and I'll say it again, it's not so much important to pay attention to the labels. Are we in a recession or are we not in a recession? That's an argument that I don't care to engage in that debate. I pay attention to the data and what's really happening going on. Look at what's happening in the data. And I want to run through a few things right now. But as I said, consumer demand has been pretty good, but it's a very mixed picture. So I have my next charts are housing, just one sector of the economy, but a very important sector of the economy. Because when people buy houses, then they buy the stuff that goes into houses. Now, housing prices are up 20% year over year in the most recent figure. And that's obscene. And the average cost of a house is obscene. And it's rendered housing unaffordable for many, many people. But if you look at housing sales, they're off 20% since January. Now, part of that's a reaction to the price. People are being priced out of buying homes. And the homes that are being bought by wealthy people who are buying more expensive houses. And that skews the average housing price higher. So that you can look at it and say, well, housing prices are up 20% year over year, but the housing sales are off 20% because the housing prices are becoming too expensive for lower income people to be able to afford houses. There is a dearth of good housing stock in America because, like as in so many other industries, the housing industry has not built the kind of housing that people want and need. They were building McMansions for decades, most of which are deteriorating because of the poor quality of the construction. But you have any number of smaller, newer, younger households that want smaller housing, and you have a lot of graying people looking for smaller housing. So you have a very tight housing stock, which is reflected in the higher prices, and you have a decline in housing sales. So it's a very mixed picture. And you can go through just about every sector of the US economy and find mixed messages as to where we are in the economy, whether it's contracting or flat are actually looking pretty strong. And that, I think, is the important thing, and it's reflected in our views of where the economy is going, and it's reflected in our views of precious metals. Few things about other things. The US dollar, again, it's not collapsing. Sorry, gold bugs. Sorry, all you promoters out there who are saying that the dollar is going to collapse. Oh, and there's this grand conspiracy to confiscate our dollars and have the great reset where we come up with something else like watches or something. All that's nonsense. The reality is that the dollar is quite a bit higher and stronger against most currencies than it was in the period from, say, 2008 to 2014. And it's kind of bumping along. And right now, we've seen the dollar rising over the last few months, partly because US interest rates are rising in advance of interest rates in other countries. So the dollar is not collapsing. Inflation is very high, the highest rate since 40 years, we keep hearing on the news. But again, this is inflation that has appeared since March and April of last year, and we're starting to see it come down. This is quarterly data through the second quarter. So we've seen over the last several months, and I've talked about this in previous things, we've started to see core and headline inflation start to weaken. June was a very bad month for inflation, which is the end of the second quarter. We saw higher prices across every sector of the consumer price index. July, we saw about half of the components of the consumer price index rising, but generally speaking, rising less than 1% month over month. And half of them were declining, generally speaking, less than 1%. Contraction in prices. So a mixed picture there. And I included the gold price here because I'd love to point this out. You can see that CPI inflation was flat. And anybody who wants to argue about, well, the CPI is a screwy number and it's all kind of smoke and mirrors, and you got to look at some guy who really doesn't know what he's talking about, who's made a composite consumer price index, and that shows 40% inflation. I don't want to have that conversation, and I don't even want to talk to those kinds of people. The CPI is a very credible measure of consumer prices, and they've been pretty much flat at relatively low levels for a long time, since 1983, 1984. They have started rising, and they're starting to show some signs of coming down. And what we saw in the 70s is not what we're seeing now. So you look at what happened in the 1970s, really 1968 through 1980, 82, when you had a long period of time when inflation was 5%, 7%, up to 14%. That's not where we are today. But the really cool thing is from 2001 to 2011, when gold prices went from $270 to $2,000 in an absence of inflation. In fact, you had a spike down in inflation during the global financial crisis and Great Recession. Gold price increases do not depend on inflation. Very important. Stop worrying about inflation, start worrying about everything else. Interest rates. People are spooked by the rise in interest rates. The purple line is the real T-bill rate. It's fallen to record lows. Inflation-adjusted interest rates are cheaper than they've ever been. And nominal interest rates are far, far, far lower than they have been at any time prior to, say, around 2002. So the rise in interest rates is probably not too scary. That's probably insufficient to have a major direct effect on inflation. Probably more interest rate increases are coming. As I've said in previous videos, the things about inflation to worry about are not the monetary factors, the factors that respond to rising interest rates and sucking out money from the economy. Those things are important, and they are having a positive effect. But you have to look at the supply side of the economy, which is really generating a lot of the inflationary pressures, and the fiscal stimuli caused by Congress and the administration, which is another factor. Those two factors have been much more important in driving prices higher over the last 16 months, and they will continue to be important inflation feeding things until they come down. Now, fiscal stimuli have come down, but it's still very much pro-inflationary price situation right now. But the reality is that interest rates should not be scary, and they shouldn't be telling you, oh my God, there's no reason to own gold. Oil prices, the chart on the left is quarterly through the second quarter, and you can see how oil prices rose almost as high as they were in 2007, 2008, prior to the Great Recession, and higher than they were in the period from 2010 to 2013, which was actually a period of modest economic growth. The chart on the right shows you just since the middle of 2019, and you can see how oil prices plummeted during the recession in 2020, and they came back up, and they've risen, and now they're off about half of what we saw in terms of the increases from October of last year into the second quarter of this year. So oil prices are coming off, and actually some economists in the oil industry are talking about $3 per gallon gasoline in the United States, possibly by September, October. And the S&P, the stock market, the equity market, obviously a major factor affecting investors' interest in gold and silver. The S&P is now off 10% from its peak at the beginning of this year. The S&P has plunged. It's gotten all the way back to where it was in the first quarter of 2021, the beginning of the economic recovery. You can see here that it is still 4 times greater than it was 10 years ago. So not too scary, but it's very important. A lot of times the correlation between changes in the equity market and changes in gold prices is virtually zero. It's like -4% for the S&P and +4% for the Dow Jones or something like that. But what's really important is investor attitudes. And when the stock market has high values, but has shown a propensity to be able to fall 15, 20%, that's when a lot of investors are wealthy still and want to protect that wealth from a decline in equities. So what you'll see a lot of times is investment demand for gold and silver, mostly gold, picks up when the stock market's high and looking vulnerable. So the fact that the stock market has come down 20% is kind of a negative for gold. If it goes back up to 4,700 for the S&P, you're going to see a lot of investors saying, wow, we just escaped kind of a nasty period of time in the first 6 months, 7 months of 2022. And stock prices are back up. Maybe I should diversify my portfolio, diversify my wealth, i.e. buy some gold and silver. So that's the situation. That's the economic and financial environment that gold and silver find themselves in the middle of August 2022. We'll be at the Silver Symposium in 2 weeks. I'll be giving a speech. It's gotten way too long right now because I was supposed to speak about the realities of the silver market, and I've had a really nice speech, about 28 slides of that, and now I've added another 22 slides, 24 slides of things that aren't real, but that people keep saying are real. So I've thrown in a whole bunch of data to say, no, don't believe that. It's wrong. Be a very interesting speech. We'll have an open forum after the speech at lunchtime where people can just ask questions. And then the night before that, on Tuesday night, we're going to have an evening presentation, The Evidence for and Against Silver Market Conspiracies, where I'll be joined by Bob Coleman and by Matthew Hunter, who is the retired former deputy director of market surveillance at the CFTC and knows more about market surveillance of futures and options markets than any of the people that you'll find on the internet. You can buy our gold, silver, platinum yearbooks. Go to our website. You can become a retail investor client. You can go to our website and find all sorts of other things. I think that's about all I have to say today. We'll talk to you on Friday. Have a good week. Take care of yourself and those around you, and take care of the whole world.